You're listening to the Unlocking Africa podcast.
We looked back at this portfolio, and the companies that were not finding follow-on funding, more than less, were the African companies. So we created an investment company in Mauritius called Africa Eats. Our advantage is that we're providing equity, and we have forever to worry about what it's worth. And if it truly is 100 years from now and we still own it, we're totally fine with that. We're going to prove that there's money to be made as a market maker so that others follow, right? We don't have any expectation we'll be the monopoly market maker. We're just the first.
Stay tuned as we bring you inspiring people who are unlocking Africa's economic potential. You're listening to the Unlocking Africa podcast with your host, Tessa Adamu.
Welcome to the Unlocking Africa podcast, where we find inspirational people who are doing inspirational things to unlock Africa's economic potential. Today, we have Luni Libes, who is a serial entrepreneur, mentor, and investor, and Chief Executive Officer of Africa Eats, an investment company lowering hunger and poverty across Africa by investing in profitable for-profit SMEs who are building food agriculture supply chains. Welcome to the podcast. How are you?
I'm good. Thank you for having me.
It's a pleasure to have you. How are things over at your end of the world? You're currently in Seattle.
Yeah, things are cold and drab over here. It's winter. I've blogged about the fact I live in the wrong time zone, but the money to fund these things is over here. So
Yes, I agree.
That way it does make sense.
Don't worry, I'm currently in the UK, so the weather isn't much better over here either.
Same weather.
Yeah. So, I'd like to get straight into it. I was hoping you can give us a nice brief introduction about who Luni Libes is.
Yeah, so I started my career 33 years ago as an entrepreneur. Started a software company here in Seattle, and that's the one failure I had. But I dusted myself off, and I did another one right after that, and then another and another and another. So there were 5 companies in 20 years. I founded 4 of them. They were backed by California venture capitalists. So I learned how venture capital works by taking the money of the experts, the California VCs.
Yeah.
And then I gave up all of the tech world in 2012 to start a business accelerator called Fledge. This was a tech-inspired accelerator, but for mission-driven for-profit companies that actually fix real problems of the world. We ran that until 2020. Invited in 100-something companies from 40 countries around the world, a large number of them from Africa. And why Africa? No one else was really serving it. There's tons of needs in terms of impact. It just all clicked. And then when the pandemic hit, we looked back at this portfolio, and the companies that were not finding follow-on funding, more than less, were the African companies. So we wrapped them up. We wrapped up the food and ag companies in Africa, which are like 24 companies, created an investment company in Mauritius called Africa Eats, raised money specifically for that cause and that mission. And here we are almost 5 years later, and these companies are thriving and growing, and we'd love to add more of them. And the big news, big milestone that we hit in December of last year is that now we're a publicly listed company. So now anybody can buy shares in this company. Anybody can provide more capital and make money while we're lowering hunger and poverty in Africa.
Amazing. Great work. So as you mentioned, 5 companies in 20 years. So you've had a long career as a serial entrepreneur. So what initially drew you to entrepreneurship?
It's just in my blood. I guess I've always been an entrepreneur. I do skip the one job I took out of college, but 3 months into that, I was supposed to start my own company.
Okay, so I guess you founded multiple businesses and investment ventures, which has led you to what you do now at Africa Eats. But what lessons from your early ventures have influenced what you're currently doing now?
Oh, God. So I did, in the midst of that transition, I did start teaching MBAs.
Oh, wow.
I taught MBAs for 9 years. And what was most interesting in the beginnings of that was that I didn't know what I knew. So at that point, I was a 20-year serial entrepreneur with 5 companies under my belt. 4 of them were still running at that point. And I had no idea why, because that's not normal. So the key lessons looking back, and I did write some books to try and tease this out. The key lesson was get it into the market. Whatever your idea is, 2 things. One, you got to get the product into the market to learn what you don't know. And 2, you got to iterate as quickly as you can to get that product to match what the market actually wants. And if you don't do that fast enough, and if you don't do that at all, there's no chance of success. And when you're doing that level of planning, work backwards as well as forwards. So what I mean by that is envision what you think this is going to look like a few years from now. So we'll drop out of the hypothetical. I wrote the business plan for Africa Eats in late 2018. It said that we were going to be a publicly listed company by 2024 or 2025. Why did it say that? Well, I knew that the investors needed a way to liquidate their investment. That was part of the overall plan. Is I needed to provide a way for them to get out, and we can talk about exits later. And so that was the solution to how they would get their capital out. And so I got to work backwards from, okay, well, if we're going to do that step in this particular year, how big does the company have to be at that moment in time to fulfill that step? And how do you get there? What are the steps required to get to that stage? And I'm doing this in 2018 before we have any funding, before we even, we had, I think, 17 companies that potentially were in the portfolio, and they were still tiny at the time. And so then once you know what the steps are to get where you're trying to go, great. Now you have to implement the first step like that. And then you're working forward again. And that's it. Like, if you just keep doing that, you either find the market and succeed, or you run out of money, one of the two.
Thank you for sharing that. So if we take a few steps back, was there a specific reason why you transitioned from running or starting software companies to focusing on impact investments?
Yeah, it's based on that teaching. So literally, it was just one of those things, happenstance. So I wake up one morning, I'm thinking about it's early 2000s. At this point, I'm 17 years into my career. So 2005, 2006, 2007. And I have 4 companies under my belt at that point, 3 of them still running. And I figure, well, I must know something. I don't know what it is, but I must know something about this startup world. I should share that. And by that point, I hadn't had the big exit and the giant success. And so I couldn't be an angel investor, which is a typical path for giving back. But I wanted to give back knowledge. So I was looking around for some place to do that. And I found a few places here and there, but nothing great. And then in 2011, I stumbled across this business school. Actually, I think it's 2010. Stumbled across this business school that happened to be in my neighborhood. And I told them, I just want to help and give back. And they said, okay, great. Just come. It's an executive MBA program. We meet in person once a month. Come sit in the back of the classroom, do whatever you want to help. Right. And then eventually they called that entrepreneur in residence. So I did that for 9 months. Well, turns out that this was the first business school in the world to teach how to solve the real problems of the world using the tools of business, how to do good and do well at the same time. It was called Bainbridge Graduate Institute. And so after 9 months of helping out there, at that point, my 5th software company, we merged it with another startup, and it left town. And so I was free to do the next thing, and I had zero desire to do another software company. At that point, because of the business school, I wanted to go do something that had more meaning in the world, had more impact in the world. And I spent about 6 months, first time in my whole career, I actually didn't jump straight into the next thing. I spent about 6 months thinking about what to do next. And what I decided to do was not one company, I decided to start a business accelerator so I could help a lot of companies, and specifically companies that were, again, solving real problems instead of just saving a dollar.
Fantastic. Very, very insightful, interesting as well. Because I know from what I've seen, Africa Eats follows a unique investment model that focuses more on long-term equity rather than your typical VC fund approach. Can you kind of walk us through in terms of how this model works and why you chose it?
Yeah, absolutely. The reason it got chosen was, again, this idea of working forwards and backwards. A typical way to invest into young companies is the venture capital model. It was invented in the 60s. The model is pretty simple. You invest some capital into the companies, you take a percentage ownership, minority ownership, and then within 10 years, that company has to be acquired or go public because the investment firm needs its cash back, right? And technically, it's trying to get 10 times its cash back. But the key is the company has to exit, as they call it, so that the investors get their money, and it has to happen within 10 years. So if you look at Africa and the African SME market, that doesn't happen. There are very, very few exits at all in Africa. And if they happen, they're not going to happen in 10 years. So that model just doesn't work. So you have to find another model. Well, you don't have to, because there's plenty of funds that are just following that model, and then they get to year 10 and they don't exit, and they just have to get extended. So I don't do those things. So I said I have to find another model that could work in this context. And I thought about Berkshire Hathaway. So for those of you who don't know, it is the 7th most valuable public company in the United States, 8th overall in the world. It's an investment company. It was started in the 1800s, but it was taken over by a guy named Warren Buffett in 1967. And he's been running it for 60 years as an investment company. It was originally a textile company. And again, it's the most successful publicly owned investment company ever. And there's some unique things about Berkshire Hathaway is that Warren Buffett writes a letter to his shareholders every year, and has since even before he controlled this company. He wrote letters to his investor partners, and these are published. You can read them. And he has all sorts of great insights and knowledge about investing styles. He has a lot of quotes that are out there on the internet. One of them is the best holding period for good investment is forever. So again, I've read the letters, I've read the biographies, I've watched him do Q&A, and decided to adopt as many of his ideas as possible. Because again, he's been highly successful over a 60-year period. So here's how it works. We make equity investments into young companies in Africa, just like a VC would. We make small investments for small percentages of the company. We do that over and over again until we own about a quarter of the company. We do everything we can to help them scale up. So most of the time of the team is spent at giving advice and making connections and helping the companies get from tens of thousands in annual revenue to $1 million in annual revenue, and then 10 million in annual revenue. And we've gotten 8 companies now from like 30, 40, 50,000 in annual revenue past $1 million. And then we hold it forever. So we're not interested in selling these companies, and neither are entrepreneurs interested in selling their companies. They all envision owning and operating, the next big brands in Africa. In the next 10 years, these will be companies that are earning 100 million in annual revenues. Some of them hopefully will get to billions in annual revenues. And we just own a little piece of them. And eventually we will list them as public companies as well. And we'll be a publicly listed investment company owning public companies instead of private companies. And then in terms of that's how it works on the entrepreneur side, and how it works on the investor side is that they give us money so we can go do this. And now that we're publicly listed, they can leave whenever they want. So they don't have to wait for anything to happen. And literally some of our oldest investors have been doing that since December. They're like, okay, I doubled my money, I'm happy. Or I doubled my money, I'll take half of it now. I'll leave the rest of it in the system. And when they do that, they're not extracting any money from these companies. They're literally selling the shares in the public stock market to other investors. And so it's really capital flowing into Africa to create growth, and then not flowing that capital back out, not extracting anything from the continent.
So as you mentioned, Africa holds equity forever. So maybe if we can look specifically at what advantages does this model have, maybe for the investor and entrepreneur?
All right, well, let's do the entrepreneur first, because there's more of them. So right now, the choices you have as an entrepreneur are kind of threefold. One, you can just keep applying for grants. There's grant capital that flows. It comes in little bits. It's hard to get, and it always comes with strings attached. But it's there. And most of my companies that I've invested in started with a small grant, a $5,000, $10,000, $20,000 grant. The next most common form of capital is debt. So you can't go to the bank to get debt, but there are impact investing funds that do debt to SMEs. Typically, they're the larger SMEs, so past $500,000 or $1 million in annual revenues, but there's debt out there. And of course, the downside of that is you have to pay it back, on a fixed schedule with interest. Typically, debt is in dollars, and typically the companies we work with are earning in local currency. So the cost of that capital can be really high depending on the devaluation of your currency in a given year. And then the other choice, which is the smaller amount of capital that's flowing around, is equity. And if you take equity from a traditional fund, then they're going to press you to exit within 10 years. And we see this because we have co-investors. And again, the entrepreneurs I'm working with don't have a desire to sell, even if there were acquisitions, which there really aren't. So our advantage is that we're providing equity, and we have forever to worry about what it's worth. And if it truly is 100 years from now and we still own it, we're totally fine with that. And then on the investor side of the picture, again, there's three buckets. So there are philanthropists that provide the money for the grants, and they're in it for the impact with no return. There are the investors that provide the money for the debt. They're taking a risk that if one loan goes bad, then they're going to lose money on that fund. The interest rates are, fairly high in American terms, but not high enough to cover 1 out of 10 loans going bad. And then on the equity side, if you're in a traditional LP, as they call it, in a traditional fund, your return is tied to exits. You are being promised that you'll get your money back in 10 years, but you probably won't. It'll probably be longer, if ever. And then the advantage of the Africa Eats model is that you provide capital, we put it to work, and that capital increases the value of the shares that you've invested in. And you can stay for 100 years if you want and give it to your grandkids, or you can leave whenever you feel like, given whatever return has accrued since then.
Through this model, many of the companies in your portfolio have shown impressive growth. I've seen that some have scaled from tens of thousands to millions in revenue. What factors do you think have contributed to this success?
There's a few. First and foremost, we found all these companies through that accelerator that I mentioned 15 minutes ago.
Yes.
So they were all seeking help in addition to money. It was a self-selected group that was open to the idea of outside assistance. And so the relationship that we created with them was far more and is far more around providing help and guidance and training than it is just about writing a check. So this is we're hands-on. We are still, we think, a growth stage accelerator. We think of it in those terms. So that's factor one. Factor two is that we provide capital in small increments, but quite often. So we don't do these big formal rounds like the VCs do. If the need of the company is $50,000 because they have an operational capital gap, like they're growing, the customers are paying them 45 days after they deliver the product, That creates a gap of capital. The banks don't fill that in. If they need that gap filled, they can come to us and say $50,000, $75,000, $100,000 for the next 6 months or 9 months. We'll provide that. We provide not only equity capital, we do debt as well. Same thing happens. A very common ask in our network is invoice financing. We'll get an email. Hi, we have a problem. We got a new customer. They would like a container a month. And again, they'll pay us 30, 45 days after the container gets to their facility. We need to pay the farmers now. We will get paid in, again, 60, 75, 90 days from now. We have the supply. We just can't afford to pay for it right now. Can we please have $25,000, $100,000, even $200,000 to fill this order? And our answer, of course, is yes. And then we get the asks around equipment. There's an opportunity. If only we had this piece of equipment, we could scale up, or if only we had this piece of equipment, we could extend into a new product line, or we need some delivery trucks, or we need some trucks to go pick up the food at the farmers, things that are equipment, in which case we'll do that as equity. So factor two is that we're very flexible in what capital we provide, and 2A or 2B, we provide that capital rather quickly. We don't do diligence for 9 or 12 or 18 or 24 months before we make an investment, because we already know the companies, because we already worked with them as an accelerator. So let's call that factor three, is that we're quick. When we have enough money, we're quick. We don't always have enough money. We've never had enough money for all the needs of all our companies. That's just reality of funding in Africa at the moment. And then the last factor is that we are with them forever. So we don't provide them any pressure like other investors. Well, if they take a loan, we want to be paid back. But we know things go wrong. We are the whole team are entrepreneurs. So we know that sometimes things go wrong. We know sometimes customers pay an extra 30 days later, or that there's glitches in the system, and what we thought was going to be 75 days winds up being 105 days. It's fine. We just do extensions when needed. And so our flexibility and our understanding of what it's like to be an entrepreneur, we'll call that the last factor. And so we do things that are just friendly and helpful to entrepreneurs, as opposed to penalizing them because life happens, because business is not always as smooth as we would hope it would be.
Yeah. I mean, we've managed to outline the positives, but obviously this comes with some risks. What are some of the biggest risks that you've encountered when investing in African agribusiness?
Absolute biggest one is weather.
Wow.
We've had crops wiped out by both floods and droughts, and too much rain and not enough rain. There were locusts one year, but luckily they didn't hit our farms. And then the second ones would be just the risks of young companies finding new customers. We had one company where we thought we had a great customer, but they just didn't pay us $500,000. They have the product, they sold the product, but they never paid us the cash. It hasn't happened too often, but it did happen to one company in one country, and that company shrunk by 80% because they never got paid.
Wow. So you highlighted weather destroying your crops. I know in the past you've also spoken about the issue of post-harvest losses in Africa. So at Africa Eats, how are you working to reduce some of this food waste and also improve food security within the agriculture sector?
Yeah, the actual solution is rather simple. Buy the food from the farmer.
Yes.
This sounds really, really simple, but the traditional supply chain that gets the food from the rural areas to the cities, it just touches too many hands and too many informal trucking companies. So typically what would happen is the farmer would grow food and have a surplus. Some middleman would come along, some aggregator would come along sometimes, not always, and buy that surplus. And they would get it to a small town or a small city, and they would do that in the back of a flatbed truck or in a van or it's strapped to a boda. And in that process of getting the food over there, some of it would get crushed. It would get wasted just in the handling. But it wouldn't be in the city yet. It would be in a small town or, again, a small city. And then that aggregator would sell to another aggregator who might put it in a box truck. And so if you just think of tomatoes, like a very common crop, like the tomatoes at the bottom of the pile in the back of the pickup truck or on the flatbed, they're going to get crushed. You're going to lose 10 or 15 or 20% of the crop as it gets driven for an hour or two. And then you're going to lose some of that crop as it literally just gets moved from truck to truck. We get rid of the post-harvest losses because we're buying as close to the farm as we can get. We're taking ownership of that food so that any losses are our bottom line losses. And we're just taking good care of the food as it gets to the cities. And so the measured, researched losses in our system are typically like 3, 4, 5%. That's it. We just have, a well taken care of box truck. And if it's a product that could get crushed, we're putting the food in plastic crates and other baskets so that the bottom layer doesn't get crushed.
So as you mentioned, you buy the food from the farmer, which has clear economic and business impact. But how do you go about measuring or tracking the social impact of your investments?
There's been some 60 decibel studies that go out and actually talk to the farmers. And in those studies, anecdotally, my entrepreneurs always say, we double the income of farmers. But we actually have quantitative research showing that we double the income of farmers. And it was only 90% of the farmers, not 100%. But we're doubling the income. So typically these are subsistence farmers or just above subsistence farmers. When we double their income, they're now median income earners for their country. So I don't want to call that middle class, but technically that's middle. And the ones that don't get doubled, I did ask about that when the research came out. Those are the ones that don't listen to the trainers. So we do buy from farmers, but we also send trainers out to improve the quality of the food and improve the yields on the farms, right? Because it's cheaper for us to have a farmer grow more food than to go and try and sign up another farmer. So there's a win-win in training them. And when I asked, they said, well, yeah, 90% listen and 10% don't. And those are the 10% that didn't double their income.
So I guess a lot of data is required to analyze and quantify this. So what role does technology play in scaling your agribusiness investments in Africa?
Not much.
Oh, not much.
Not way less than everybody thinks. So the two key technologies for what we do are the cell phone and the truck. And people don't even think of trucks as technology, but 140 years ago, we didn't have trucks. It is a technology. That's the key driving technology to make this work. And then the cell phones are there so that we know when the food is ready to be picked up. There is some other technology used by some of our companies to optimize that process, but it's all off the shelf. Except for one of our companies, nothing's built bespoke for the operations of their company.
So I guess moving on from the technology, what role does government policies or government initiatives play in enabling or maybe obstructing your efforts?
Yeah, not a lot. Biggest thing we see, so our companies tend to aggregate everyday foods. So that's potatoes and bananas and rice and beans and chickens and goats. So we're not doing cash crops. We're doing everyday foods. And I think like 95% of the food that we're buying from farmers is sold in the country where it's grown. So we don't rub up against a lot of government policies. And there aren't a lot of restrictions on food products sold inside the country because this is how the people get fed. What we tend to see is what happens when our companies get big enough that they want to start working across borders. And there is the free trade zone nominally, but it's not the same as the free trade zone in Europe where the truck just drives across the border. We're in the free trade zone where the truck sits at the border for half a day, fills out some paperwork, and maybe doesn't have to pay a fee to based on the value in the back of the cargo, but still pays a fee to cross the border. That's the biggest obstruction we have at the moment is free movement of food.
If we look at some of the other initiatives you're involved in, I guess primarily SEMX, can you explain to us what this is?
Sure. So we started working on this in October of 23. This project was a hypothesis that there is capital available for SMEs, African SMEs, in the public capital markets. And so when I was explaining like the sources of capital, all those funds that are providing money to African SMEs, they're all in the private equity and private debt space, right? Some of them are funded by governments. The rest are funded by high net worth individuals. But the money's all privately invested in private companies structured in private investment vehicles. And we asked the question, well, why can't the public capital markets fund these companies? And there was no good reason why they can't. There was just no history of these capital markets doing that. So we looked at all the stock markets in sub-Saharan Africa, and we chose the stock market in Mauritius to start with. And so we reached out to them in October of 23 and asked if they were interested in creating a new segment on their stock market focused on fast-growing, profitable companies. And specifically, we're going to bring them African SMEs. And they said yes. So we spent most of 2024 until December 3rd of 2024 creating this segment, warming up the market for launching 3 companies in this segment. And we got that done by December 3rd. So Africa Eats, Elite Meat Processing, and Zueto Enterprises are the first 3 companies listed on the SEMX, which is part of the SEM, just to be clear, the Stock Exchange of Mauritius. And we successfully raised money from 88 investors, 8 of which were institutional investors. And we proved in a very small way, in a baby step, that yes, the public capital markets will in fact fund African SMEs if they are fast growing and profitable. That was the constraints we put on. And a few things we did with this, which was novel, besides the style of companies we were bringing. This is a part of the market that's harder to get onto than normal. If you look at what's been tried in the past, there's this thing in London called the AIM. I don't remember what it stands for. They watered down the rules. They made it easier to list. It's a separate board on their stock exchange. It's the lesser board. It's the warm-up board. And because of that, few of the institutional investors care about the stocks that are listed there. But nonetheless, it was London, so it got copied in Nairobi as the GEMS. It got copied in Mauritius as the DEM. It got copied all over the world in all sorts of different stock exchanges. And I've never seen it work. We'd never seen that style work. So we went the other way. We said we want to make it harder to get on the stock market than normal. And so in order to be listed on the SEMX, you have to follow all the rules of the normal stock market, and the companies have to be growing. Top line revenue growth has to be at least 25% compounded over the last 5 years. You have to have profits. So none of the stuff that we do in the tech world with promises of future profits. Nope, you have to be a profitable company in order to be listed. Yeah, it can't be all built on debt. You have to have a decent debt to equity ratio, and a few other things to make it harder to get on than normal. And we at Africa Eats, we have 7 companies that qualify for this. We listed the first 2 last year. We will list more each year.
Brilliant. So as you mentioned, the SEMX initiative, the aim is to bridge the capital gap for African SMEs by accessing public capital markets. So how exactly does it work?
So these are companies that are live listed on the stock market. If you happen to have a brokerage account in Mauritius, you can buy shares.
Okay.
Now, of course, that sounds a little flippant. Most people in the world don't have a brokerage account in Mauritius. So we did something else to help make this useful for the rest of the world. We created another company. It's called Tuesday Markets. And it does 2 things. One, it built an app. So if you go to tuesday.africa, you will find an app that lets you buy and sell shares on the SEMX. Just these three companies for now. Anybody can sign up. In signing up, you wind up with a brokerage account in Mauritius. And then, again, it's open to anyone in the world. The shares are $2.32 down to $1.65, I think, for Zoeto. One share. You can buy one share if you want. So minimum investment is now down to dollars instead of tens of thousands of dollars. You can sell those shares anytime you want. And then the other thing that Tuesday Markets does is it's the first equity market maker in sub-Saharan Africa. So it's providing the buyers when no one is buying and the seller when no one is selling. And so these shares are liquid. They're as liquid as they would be in New York or London. 5 days a week, whenever the market's open, you can buy and sell the shares. There's always a buyer and there's always a seller. That's Tuesday Markets.
So why was Mauritius chosen as the initial listing location for the SEMX initiative?
So Mauritius is part of the African Union. It's off out into the Indian Ocean, so it's kind of Africa and it's kind of not Africa at the same time. But the reason we picked it was it's a stable country with a very good international banking system. A trusted place to create a Pan-African company. And they have a stock market that has a 36-year history. And probably on top of all of that, the reason we picked it was it had a stock market where we could list in dollars and a history of doing that. Like we didn't have to create that for them. And so we do all our business in dollars because we're Pan-African. Our companies are in 8 different countries. They work in 9 different currencies. Right, dollars being one of them. But the only commonality we have is we can measure everything in dollars. So our shares are priced in dollars, they trade in dollars, and we couldn't do that in Johannesburg or Kenya or Nigeria or anywhere else on the continent.
It makes perfect sense as it reduces risk and certain challenges. But I was wondering, what challenges, from your experience, do African SMEs face when trying to go public?
Well, we don't know because this is the first 2 I've ever seen. So the biggest challenge SMEs face, period, is lack of capital. And so again, going back to the stories of operational capital, you can only get to be bigger by having operational capital gaps. I've only seen it once where you can grow your company past $1 million because your customers are paying you when you need the money, as opposed to after, a month or 2 after you deliver the product. And so it's hard to get to the scale where you could go public. And then once you're even in the process of the roadshow that we did to sell these companies to these public equity investors, well, they don't know. They don't know all these woes. There aren't a dozen SMEs listed in Africa that they have experience with. These are the first ones they've seen. So we had to do a lot of education about how did we get these companies from 30,000 in annual revenue to $1.5 million ish. Those are the 2 we listed. One was like 1.4, the other was 1.6 ish. Bringing novel things to the market is scary to public equity investors, just like it is to private equity investors. The public equity investors are used to investing in banks and insurance companies and conglomerates and other businesses that are big and old and slow growing and not scary in any way. And here we were bringing them pretty young companies that were growing at 25, 30, 40, 50% annual growth that didn't look anything like they were used to.
You mentioned the lack of capital. I know previously you've mentioned that African stock exchanges suffer from illiquidity issues. How would the SEMX's structured IPO and the market-making mechanisms solve some of these issues?
The market maker's there to provide some peace of mind and comfort to the investors. So again, if you go back to the model I said doesn't work, where the investors provide the money and they're promised that they'll get it back in 10 years, that's illiquid. Like that's the poster child for illiquid. The public equity investors worry that they'll buy the shares of Africa Eats or these companies, and that they won't be able to sell that there won't be a buyer when they want to sell their shares. So by creating a market maker, there's a guaranteed buyer. And the market maker lists always on the market a price they're willing to buy and a price they're willing to sell. So not only is there comfort that there will be a buyer, but the investor knows what the price will be. It's listed publicly. It's sitting there on the stock market for them to act on. No negotiation needed, no paperwork needed. Literally, there's a buyer there when they want to sell. So that's why the market maker exists. When we sat down with them back in October of 23, there were 20 chapters to their rule book on how to list on their stock exchange. And now there's 21. So chapter 21 describes what I said before about raising the bar, making it harder to list. And then the second half of chapter 21 is how market makers work with these shares, with these companies. And the first line of that second part is, if you're listing on the SEMX, you should bring a market maker. And again, Tuesday Markets is the first one. The expectation we have is that we will prove that Tuesday Markets is a for-profit company. It's got its own funding. It's got its own investors. We're going to prove that there's money to be made as a market maker so that others follow, right? We don't have any expectation we'll be the monopoly market maker. We're just the first.
Amazing. So with what you're doing, do you see SEMX expanding beyond agriculture into other industries?
Yeah, so there's nothing in the SEMX rules that say anything about agriculture or SMEs or any of that. It is a public set of rules that's open to anybody who would like to use them. And the stock market would love to have more listings. And we expect others will follow us. We're just pioneering this space. And then for expansion, we are talking to other stock markets on the continent to join in this effort to make this SEMX, although probably won't be called that in other stock markets, but to make this segment of fast-growing, profitable companies something that they have too. And our long-term vision, again, working backwards, our 2030 vision is that when an SME wants to list on the SEMX, that winds up having them being visible and listed on every important stock exchange in sub-Saharan Africa, just all in one go. You list and you're suddenly visible on 7 or 8 or 9 stock markets, and you have access to all of the investors with brokerage accounts in any country in sub-Saharan Africa, not just Mauritius.
Brilliant. So if we look ahead, where do you see Africa Eats in 5 years' time?
5. So that's 2030. By 2030, we should be talking about when we'll hit $1 billion market cap. I don't know how close we'll be by then. I don't think it'll be 2030. But we'll be past 100 million by then. And at that point, again, the same vision, we should be a public company listed on many stock exchanges with tens of thousands, hopefully, of shareholders, right? As opposed to 175 today. In 5 years, we should have more than doubled the portfolio of companies. We have 23 active companies today. So hopefully we're past 50 by then. It'd be lovely if it was counted in the hundreds by then. And in terms of growth of these companies, last year our companies did more than $40 million in revenues combined. Up from $1 million in 2015. So 10 years it took to get 40x growth. Again, well past 100 million in aggregate revenues across these companies. By 5 years, it should be 200 or 300 million. And we should have at least one that's talking about being 100 million just on its own. We should be just about there in about 5 years. And again, 5 years, that's a drop in the bucket. This is a permanent vehicle. We compare ourselves to Berkshire Hathaway. They're 60 years into their current business model. In 5 more years, we'll be 10 years in. So we got a lot more growth to go after 5 years.
Brilliant. So if you look at the future of Africa, the agriculture space, how do you see Africa's agriculture investment space evolving in 5 years?
Hopefully other people wake up and start investing alongside us, as well as through us. But it's the biggest sector there is in the economy of Africa.
Yeah.
It's the one industry where the addressable market is the entire continent. So there's 1.2 billion sub-Saharan Africans. They eat every day, or they want to eat every day. In 5 years, there's going to be there's going to be more than 1.5 billion. Population will be double in 2045. So the opportunity size is growing tremendously. And then in terms of impacts, we know there's enough land and enough farmers to grow all the food needed for 2 billion Africans. It's just a matter of getting the supply chain built out. So this is why we focus. Again, we're trying to solve hunger and poverty, and we do that by building out a modern supply chain, which sounds weird because when we say hunger and poverty, people think of charity. People think of philanthropy. Yeah. That's not the solution. The solution is literally the supply chain. It's the same way that America became rich and the same way Europe became rich. They built out their food and egg supply chains in the middle of the 1800s, like just when trains were starting to roll out. Then the people could leave the rural areas, work in the cities, and build out the factories and whatnot. You can't do that until you have less than half your population growing the food.
Quote of the week.
As people, we often have quotes, proverbs, affirmations that keep us going when times are challenging or when times are good. Do you have one that you live by that you can share with us?
Yes, one I learned in visiting the Dalai Lama in India.
Oh, wow.
They have it's another story. They have a saying in Tibet, which is, tomorrow will be worse, and then it'll get better. So, I grew up, and the repeated phrase and proverb here in the States is things will get better. Right? It'll turn around. It'll work out. It'll get better. But it really struck me that the saying in Tibet over and over again was, things will get worse. So I'm an entrepreneur. There's ups and downs. By now, I'm used to it. I know that it'll turn around at some point. But I just love this idea that, it probably will get worse before it gets better.
I've not heard that one before, but I actually love it. So thank you for sharing it. We've come to the end of today's conversation. It's been a very enjoyable conversation. Luni, thank you for sharing your journey, wisdom with us. We'll be watching closely as we see Africa Eat and the SEMX initiative continue to grow and drive change. So fantastic. It's been an absolute pleasure having you on the podcast.
No, my pleasure. Thanks for letting me share the stories.
Thank you to everyone who has listened and stayed tuned to the podcast. If you've enjoyed this episode, please subscribe, share, or tell a friend about it. You can also rate, review us in Apple Podcasts or wherever you download your podcast. Thank you, and see you next week for the Unlocking Africa podcast.